Hello and welcome to Weekend Investing Daily Bytes. We're shooting episode 232. It is 23rd of May and we're going to visit the past bear markets in the US and the data around that. The US markets briefly touched a minus 20% point, which kind of is defined as start of a bear market, and we'll see how the past bear drops in the US market have been. Largely, we are focusing on the US market here because that is the mother market of the world, and most markets follow the lead taken by the mother market, whether we like it or not. In terms of the market action today, markets were very firm in the morning, but gave up the entire gains and more by the close. So it is still yet to be seen whether we've created some sort of an intermediate bottom and want to go up, and this so far seems just like a bounce. Whether we can sustain this area of Nifty a few hundred points below this, around 16,000, or we go much lower is yet to be seen. Specifically today, metals and commodities were thrashed. You can see the metal index is down 8% just today. The government has taken several measures for controlling inflation. One of them was to increase the excise duty on imports of steel, on certain steel products, thus giving protection to the local steel producers. But what that will enable other industries, other manufacturing companies to source local steel, while the producers are not able to match the price from overseas. That caused several large steel counters to collapse today. Another measure, of course, taken over the weekend was to reduce the excise on petrol and diesel, and that should result in some sort of a at least a demand increase in consumption, given that people may have a little more discretionary money left with them post this fall. So both measures are in the line of bolstering the local economy. Autos were in the green today, largely due to the fact that lower metal prices will help them here, and the IT stocks have been sort of recovering since the major drubbing they had in the last month. They're down about 10%, but no real sort of recovery as such, and most other sectors were flat or slightly negative. Again, it's sort of a ranged market without any major direction, but some pockets have shown some strength, and those are riding higher. You can see in the broader indices here, almost all indices between 0.5% and 0.87%. Specific stocks groups like Adani stocks, most of them were beaten today. Small cap stocks were down 0.7%, and Nifty was down only 0.32%. Within the weekend investing performances, NNF10 was badly hit at minus 1.32%, MI20 minus 2%, MI35 minus 1%, MI8H2 0.85%. So this continued to fall here, and some small gains on ATH all cap and NG5050. We've also added the cash component that we have raised in several of these strategies. So ATH, MI all cap, LTC next 200, MI25 are sitting on large cash right now. MI30, MI50 also have decent cash. ATH is fully deployed, and the other ones are not absolute momentum strategies, they never go to cash, and hence that's not applicable on the other strategies. In terms of the top gainers, there were sporadic big gainers: Sequent Scientific 14%, Star Health 9%, VMart and Paytm about 8%. That's a very encouraging move there. Cochin Shipyard up 6%. On the downside, mainly metal space 18%, Jindal Stainless 17% Jindal Steel, 16% Jindal SR, JSW 13%, Tata Steel 12.6%. This was really a bolt from the blue, and the industry probably was not expecting this. And these kind of overriding regulations and government policies do hurt several companies, but that's how the markets are designed, that suddenly there can be a guidance from the government which can ruin all the plans that you were making just 24 hours back. So all the narrative about steel remaining firm has got smashed just by one diktat from the government. So the lesson from here is that you can never sort of put all your eggs in one basket in terms of one sector or even one asset class, because you never know what may come and hit you at any point of time. So safety is sort of first safety should be your first concern when you're designing or reorganizing your portfolio. In terms of the bear markets in the US, we have had 14 bear markets in the last 100 odd years. The fall in each bear market has been from 20% to 86%. In the current fall, that's the first entry, Jan 22 to till whenever it will end, we're down 21%. And the worst fall was the 1929 crisis, the Great Depression. That fall was to 86% within a span of less than 4 years. So this is also linked with whether there was a recession along with these bear markets. So several of these falls also resulted in recessions in the economy. So whether it was 2020 March, this great financial crisis, the dot-com crash here, and I think this 1990 was the Gulf crisis. Then you had the 1980 Black Monday fall after a huge run-up before that. And then there were several other crises, from US war with Vietnam and dollar going off the gold standard, or at least the Plaza Accord that happened in 1972 or 73, I believe. That was a tough time for the US market as well. So several such periods where it's been a tough ride in the equities. If you ask me, the last 2 decades have been the best times for equity market. Since 2000, we've had just 2 major episodes of 2008, the great financial crisis, and the COVID crisis, over 20 years. And I think previous to that, we've had maybe slightly higher frequency than that. But nevertheless, the average fall, although average does not really, bring out any meaningful inference, but 36% has been the average fall, and we are now at 21. So in case we have to go to average, we'll fall another, maybe 15 odd percent or 15 to 20%. and that will definitely be devastating if we reach there. A lot of folks, more than I think 60 or 70% of the new demat accounts have never seen that kind of a fall. So that will be hurting a lot of people. It hurts everybody, but it hurts newer players more because they don't even have a cushion on what the capital that they brought into the market. So if I wanted to just concentrate on this part of the table, then you can see that from 1929 till about let's say the first 30 years after 29 till 1957, you had almost 8 bear markets in 30 years. So every 4 or 5 years you had one huge one, and very deep ones, 86, 41, 34, 54, 46, so on and so forth. So besides these two here, I mean, most of these are in low 20s, etc. And the COVID was a huge one as well. So while we can look at this table and have a lot of fear, I would also say that you can look at it positively, that in case we have to fall to the average, we've done more than half of that. Hopefully we have fallen to the bottom and will rise from here, but I cannot say that for sure. Also you can take the positivity that despite so many bear runs in the market, compounding has been achieved over the last 3-4 decades in every market, whether it is US market or Indian market. If the strategy was right, if the strategy caused you to remain in the strongest stocks, these are periodic speed breakers, I would say. So from that perspective, despite all this mayhem and all this red marks, equity curve over the last 10 decades is basically flat up, and this is sort of the cost one pays to get that premium from equity, that you have to bear the volatility because you're making much more returns than the average Joe out there. So there's no gain without any pain. So this is the pain that one has to bear on that. The world is not a very easy place right now. This was just one chart that was there posted on Twitter. Almost a 7-decade high inflation number from Germany. I mean, these economies are not used to seeing more than 4-5% inflation, and to see multifolds of that, I don't know what is the future and how hard the interest rates will have to go up to curb this, and can the economy really sustain that kind of a interest hike. So it is sort of a catch-22. If you tighten, you collapse the growth and collapse the economy, but contain the inflation. If you don't tighten, the economy can keep growing at 1-2% in the Western world, but the inflation has got out of hand. So it's a major catch-22, and I frankly have no idea how it will get resolved. But that's the insight, and that's how things stand right now. And another one was this chart of Walmart. I thought Walmart is such a strong global brand, and to see that stock going from 160 to 119 in just a matter of days was pretty hard to even imagine. And the market is sort of telling us that nothing is impossible, everything can be vulnerable. And the kind of valuations some stocks sit in our markets also, if tomorrow they half, they will still be justified at those valuations. So I mean, nothing is sacrosanct in terms of that it cannot fall. Get that sort of fake confidence out of your head. So we need to have plans for every kind of eventualities. We do have exit strategies in momentum strategies which try to curb the losses when they happen. Sometimes we succeed, sometimes we don't, but Definitely not having any plan is very injurious to your portfolio's health, whether momentum, whether value, whichever way you may see it. So do try to create a framework around your investing, and I hope that everybody will have a safe investing journey in their lives. Uh, so with this, I come to the end of this daily bite. Thank you so much for watching. Please do share this with whoever you think can make use of it, and I'll be most grateful to you. Thank you. Bye.